AIM has a reputation for providing investors with a high risk appetite, a marketplace for speculation, risk-taking and boom or bust opportunities that are often binary. Now, there are certain constituents that provide that, and for many people that is the attraction of investing in AIM. As you'd expect though, despite a number of multiple fold winners, there's also been a long history of failures. And invariably those failures are the companies that attract the most media attention. And that clearly impacts the public's perception of AIM. Now, what that opinion ignores though, is that there are many companies on AIM that offer the opportunity for investors to take that higher degree of risk, but also with cash generative, profitable businesses that offer investors the chance to receive an attractive yield along the way. Investing in AIM doesn't have to be a roller coaster of volatility made up of mining plays, oil and gas plays that are attempting to discover significant resources, or pharmaceutical companies that are looking to achieve medical success from trials. And in this short piece, I'm just going to highlight two of our favourite examples of companies that we've backed that offer both a decent yield with a dividend cover that gives confidence, along with a market cap above £20 million. It's not going to take a rocket scientist to figure out that Duke Royalty are a royalty business. They provide capital to established small businesses to address funding gaps. And they've got a management team with a wealth of experience in that particular sector. Now, there are some big success stories in this sector, which is significantly larger in the US and Canada, sort of £45 billion sector. Alaris Royalty Corporation, they play in the same space, capped at about 700 million Canadian dollars. And we haven't really seen much of that in Europe. I think the best way to describe their product is almost like a corporate mortgage. The loans generally have 25 to 40-year terms with an interest rate of 12 to 15%. Duke Royalty become the senior secured lender, so they have the right over the company's assets if the company defaults. And although the interest rate is higher, the cash flow actually needed to finance the loan is small given the lengthy term. Now that significantly reduces monthly outgoings to the borrower, which helps their cash flow and enables them to use it for other things. They are, however, different to mortgages because the monthly repayment of the royalty will increase and decrease annually between plus or minus 6% based on the revenue performance of that business. So if the business does well, the royalty goes up. Naturally, therefore, the success of the company relies heavily on being able to lend money to businesses that perform well. If the investee companies see the revenues fall, the interest payment on the loans will fall. To mitigate some of this risk, businesses for Duke Royalty are actually sourced by relationships they have with Oliver Wyman. They're a global management consultant owned by a Fortune 500 player. And Duke pay away 4% of that royalty payment to those guys to do all of the due diligence. And they manage to still retain 96%. Oliver Wyman have 40 non-disclosure agreements signed for over £650 million worth of deal value. So the potential pipeline for Duke Royalty is significant. As far as the revenue stream is concerned, the royalty revenue stream now exceeds £4 million a year, and the company are actually targeting to pay out 80% plus of earnings. So that's going to enable them to pay a market-leading dividend for 2019. The 2018 dividend at 43.6p per share is forecast to be around 4.8%, which reflects the build-up of investment. That's then going to rise to 6.4% for 2019. The longer-term target is around the 8% mark. Current PE ratio of 14 times is not reflecting the quality of those longer-term earnings. I think probably a 20 times PE ratio would be fairer. If you look at both Alaris and Diversified Royalty, the bigger Canadian players, they trade on PEs of 24 times as of December 17. So they're very much under the investor radar at the moment, I think, Duke Royalty, but we would expect that to change as this dividend becomes apparent. The second business is Fulcrum Utility Services. And they're the UK's leading design, builder, owner and operator of utility connection services. And if you think about it, they're basically the last line of connection for gas and electricity from the grid to houses and businesses. So their customers are house builders, developers, or businesses looking to connect up to the utilities grid. They've got a national position, 1,200 clients, and 60% of their revenue is repeat revenue. They've got double-digit operating margins, strong cash generation, and also a progressive dividend. So certainly fit the bill in that sense. They actually use their spare cash flow, and this is what we like the most, from actually completing their day-to-day work, connecting businesses to the grid, to actually acquire gas assets. Now that provides them a long-term yield. It's a mix of domestic, industrial and commercial pipelines and meterage across the UK, and they get paid a fee as the gas flows through them. So that generates them a 10% yield on their investment, which falls straight through to their bottom line. They've recently started doing the same thing with electrical cabling as well. Following a recent acquisition, they're actually going to have the licenses and the capability to do everything in the market. So end clients will be able to use them for both gas and electric. And people like using a one-stop shop. Fulcrum have got 12% of the gas market. They're going to have 5% of the electricity market now. With the £14 million of cash they've got, they've already committed to further asset purchases from third parties who can't own their own assets. Now that stands at £7.5 million at the moment, and that cash is going to be spent as the assets are built out. So they're going to get the 10% yield on the gas and electricity assets, and they can have a 40-year life, some of these. So current business, forecast PE for the combined group, including that acquisition, is 13.9 times for 2019, but they also hold £10 million in cash at the end of this year. If you strip that cash out, it falls to 12.7 times. The house broker estimate that full year EBITDA should be at £12 million, and Senkos also think that profit before tax should be at around £11 million. Dividend per share of 2.5p equates to a 3.4% yield at the current price of 73p. So both them and Duke Royalty, although they have their associated risks, as you'd expect, for the adventurous investor that's looking for a steady yield with opportunity for a decent amount of capital appreciation to boot, both of those companies, which we think are extremely exciting, fit the bill very nicely.